Now we get to turn to our favorite topic, which is Asia, and we're going to look at some of the recent Chinese data. Now, for those that have been following us on Twitter or following us on our recent shows, we've been talking about the issues and how they've compounded. Now, one of the things that we've said is a lot of people turned away from the issues on debt, assuming that the PBOC was going to get in front of it, the CCP was going to get in front of it. But we've been talking about there are structural problems. This is not a cyclical issue, but structural, and it's going to take a lot of reform and as well as a lot of pain to get to the other side. And that's why people, I don't know if they got bored, if there weren't new headlines, because there wasn't really a impact point. But and this is, again, tying it back to the first segment, we talked about the maturity wall, and we're getting to that maturity wall. But the problem that we've talked about on the spending front, especially when you look at the consumer invested a lot in these trusts, these MVPs, and other types of real estate linked components, and they're going belly up now. They were assuming that they were going to pay 7%, and then they go to get their principal, and it's gone. That's a problem when you look at what comes next and how is a person, an individual, going to spend if the money that they were relying on is now gone. And that's why we think that there's a huge connection. And people like to say it's like, oh, they're connected. It's all internal debt. Therefore, the PBOC can make it go away. It's like, but they're not. It's all connected, especially to the consumer. So when you look at some of the different pieces, and I think it's also important to highlight that just because I think China is overvalued and China is going into this huge struggle, I'm not sitting here saying that the world is in a better place, that it's only China in this massive debt bubble and everyone else is experiencing massive growth. No, that is not how this works. China is the second largest economy in the world. If they're going to feel pain, it's because they're getting outside pressure that is showing the cracks and expanding those cracks. So we're not sitting here saying, oh, well, China is in trouble, therefore the US is better. It's like, no, everyone's in trouble. China just happens to be in more trouble because of the structural issues that they've been facing, because of the leverage they've used over the last 20 years. It is now all coming to a head, which is why we see the issues that we see and why we talk so much about China versus some of the other places within Asia and within the world. So when we look at China, here you can see that the aggregate financing was a huge swing and a miss. It was expected to be at 1.1 trillion, came at 528 billion. Then that obviously resulted in a slowdown in M2, in M0. C and Y new loans expected to be at 780 billion, came in at 345. Money supply for M1 came down. Now, for those that have been following us, we've said from the very beginning, and the PBOC laid this out back in 2019, was that leverage was an issue. They have to get in front of that. And the idea was bring credit impulses to 0 or below and slowly do it, not send credit impulses to -20, but get them to a stagnating point where you're slowly draining that liquidity out. Now, obviously they've had issues, but even through COVID, even through all of these things, they've continued to maintain that. Now it's actually gone too far, and we're going to start to see some of that reversal and some of that pick back up. Because again, the pendulum it's not like you can point it to a spot and then just keep it at this one level. No, it's a beast. It's a living thing. So you have to try to massage it up and down, which is what we're seeing here. They came out and surprised and cut rates. The 1-year medium term was expected to be at 2.65%, came in at 2.5. The lending facilities was expected to be at 410 billion, came in at 401. So even though they're saying this, it's important to appreciate that there's no demand for debt. So whether you cut rates, there's no demand for it. So you can cut rates all you want. It doesn't mean that people are going to borrow more because they're already so levered. It will help them roll their debt, but it's not going to prompt them to borrow more. So again, it's just those things, those supply side things will continue to fall on deaf ears. Industrial production was expected to be up 4.3%, came up 3.7%. Retail sales was expected to be up 4%, came in up 2.5%. Again, and these are Chinese numbers, so you can take them for a grain of salt. But based on what we're seeing and what we've been talking about, these are jiving closer to what we were expecting, where we're not saying that China is going into this massive recession. It's just growth is not going to be what the market expects, not even what they're guiding to. And that's where we see some of these different adjustments. Fixed assets investment expected to be at 3.7%, came in at 3.4%. Property investment was supposed to be negative 8.1%, came in at negative 8.5%. Residential property sales was previous month was 3.7%, came in at 0.7%. So again, you're starting to see these pressure points. And while this is happening, the yuan broke a key level, and it actually got to $7.34 per dollar, which was the weakest since November of 2022. And we're going to talk about more of that in a minute. But the PBOC stepped in and they started to protect some of this, which is why actually at the moment it's at 7.28, because but there's a lot of betting against it. And that's the problem when you look at what is happening here. And you've seen it with the BOJ. You've seen it when you start trying to protect a currency or set a floor in a rate. The market can smell it. It can sniff it out. And then it pushes it until it breaks, until you can actually crack it, because the money you make on the break is massive, and there's a huge amount of reward for doing it. And those are the invisible hands, if you want to call them, market spirits, I think they call it, animal spirits. That's what it is. So again, like those are things that you have to watch. Now, the Chinese statistics expectations weren't high, and that's the other thing. Expectations weren't strong, and yet it still disappointed. The growth figures across the board came in below consensus. Retail sales numbers are the nail in the coffin for hopes that consumption will power the recovery. Retail sales in July fell 0.1% month on month after seasonal adjustment. So again, actually negative. And now this is where things are continuing to get worse. Data also points to a broader private sector malaise. Private investment fell 2.3% in July compared with 0.6% contraction in June. And now they've gone too far down, hitting on the private sector. And unfortunately, we don't see that adjusting because, again, there's no reason to go into China now based on all of them, or at least, invest there, because there's better places to be based on IP, based on protection. And they've cracked down on the private sector. So why am I going to go in there and risk something, going into China? Higher unemployment rates suggest that private firms, the main source of new jobs, have reduced hiring. And there's a lot of people out there that say, oh, the SOEs will take care of it, or the CCP will take care of it. So private firms are the largest source of jobs. So it's not going to be something where they're going to easily get away from this. So far this year, the private sector weakness has been partially offset by an increase in state spending, but that wasn't the case in July. So there has been some offset, but what we're saying is they can't carry it all. And then they're going to reach a point of saturation, and then they drop off, and we're starting to get to that point. It's now an open and shut case that officials are not doing enough to support economic recovery. Today's rate cut suggests that Beijing is aware, but again, it's going to be difficult than just cheaper credit. So Premier Li is keeping the government laser focused on the economy. And now remember, they're planning their plenum, which should be in October, I think is what they're gunning for. But there's still a focus on delivering solutions. So the meeting there was a Wednesday State Council plenary meeting convinced to look at some big focal points: boosting consumption, stimulating investment, promoting industrial upgrading, proactively helping businesses, things that they've said. And this is what we keep coming back to with the rhetoric. They've said all of that. The problem is they don't have tax revenue. So, and we'll talk, and we have charts on the tax revenue issue going forward. This is not something where it's like, oh, well, it'll just get better. It's like, that's not how this goes, especially when you start looking at these issues on the LGFVs, as we've talked about significantly on a continuous basis. The local government financing vehicle debt burden by provinces, firms and nations southwest, north faced higher bond financing costs and shorter maturities, which is why things are getting a bit, again, it's not uniform. Everyone is going to experience something different. And this is why one of their focuses is on the rural side, because those are the ones that are facing higher bond financing costs and the shorter maturity. But again, by trying to save this, you're taking away assets that can go other places as well. So, and not to say that you can expand yourself too thin, but these are some of the bigger issues. So China will allow provincial level governments to raise about 1 trillion yuan via bond sales to repay the debt of local government financing vehicles and other off-balance sheet issuers. So again, it's a bailout from a provincial level. So when people say it's like, well, the CCP doesn't have a lot of debt, it's like, but it does, because it all again rolls to the top, which is why they're trying to get in front of it earlier. And this is before they even really know what is the full extent of the leverage at these levels. The Ministry of Finance has informed relevant authorities about the refinancing program. People with knowledge of the matter said asking not to be identified. Obviously, the quota has been set for each region. So they're setting quotas, which we know don't go well. All provincial level governments but Beijing, Shanghai, Guangdong, and Tibet will be able to use the bonds to repay off-balance sheet liabilities known as hidden debt. Authorities also identified 12 provinces and cities as high-risk areas where more support will be provided, including Guangzhou, Hunan, Jilin, and Hannu. So again, it's an issue where it's not going away, and because my pronunciation is terrible, it's stuff in the upper right and then the top left that you're seeing a lot of the support, because there's so many issues when you look at the amount of leverage that is there, and it's being backed by an infrastructure that just isn't functioning or isn't working or covering the debt the way it should. Growth of outstanding credit continues to weaken. Bank loans, excluding loans to financial sectors, is now at the lowest it's been since 2015, with the bank loans also trending and the broad credit also trending in that direction. Again, not something that rates are going to fix, because it's just there's so much out there. It's going to be difficult to get someone to take additional. Now, when we talk about, and we're going to look at some of the things that are happening at some of the different levels, people in China are very levered to home prices. They're very levered to real estate. So when you look at the price declines on home prices, you're looking at a decline that's anywhere between 10 to 30%. Now, the official data is showing something closer to 1%, which may be the case on a broad spectrum, but when you look at some of the bigger areas, you have a massive loss. And unfortunately, that impacts the amount of wealth people have, what they can borrow against, but also how they quote unquote feel, which is going to make it very difficult for them to go out and spend frivolously. China's property slump looks far worse than official data. Since the peak in 2021, home prices are down at least 15% in prime areas and about 25% near some other like non-prime areas. A rumor said large private equity and trust groups in China facing huge liquidity crises leading to the suspension of payments. The rumor went viral on WeChat, and you've seen that hit with Everbright Trust, Minmentals Trust, and AVIC Trust issued in urgent statements to refute the claims. But then that rebuttal is a good way to say it, was kind of hard after Zhanggrong, partly owned by the investment group, is one of the biggest players in the shadow banking, which is with about $3 trillion. The shadow bank is about $3 trillion US dollars. But in these areas, they're considered trusts, but the doubts over its health have added to mounting concerns as they've failed to pay back dozens of products. Now, the problem is people wanted to get exposure. So what did they do? They went out and they invested in these trusts, which were paying 5-7%. They were supposed to mature, and then there was nothing on the back end. And that's why you're starting to see people getting very scared. There was actually some recent protests. Now, China's official home price indicates some resilience, as you can see, but again, it's still moving to the downside. Then you look at residential real estate activity. Again, why we think the data is obviously worse. Floor space sold, floor space started, continues to move down. And then the China new home prices coming in at negative 2.23. Again, you're seeing that pressure, and it's unlikely we're seeing much change. Now, Beijing needs more money. That's according to the outspoken former finance minister, because, and we've talked about this before, structural changes like aging population, low birth rate, and education inequality, China's government revenue to GDP ratio is well below that of developed economies, because they've given so many tax incentives And they don't really collect taxes the way they're supposed to on an income side and whatnot, or as they should on a property basis. So they want to raise the value add tax and rolling out a property tax. Lou has the right diagnosis, but the wrong prescription. VAT taxes are it can exacerbate income inequalities, will then stifle some of the spending at the top, which is what is a big component or a big role in consumption is at that top end. And then the property tax is just politically feasible, meaning it only targets a narrow subsection of homeowners and it doesn't tank the property market, won't raise sufficient revenue. So again, there's a lot of issues in terms of trying to roll this out. China needs to widen the tax base and shift towards progressive direct taxes on household incomes, which is going to be difficult in terms of where they are. And then a former high-ranking official openly called for increased taxation. Taxation will be a key policy, but you're taxing people when they're already not spending what you want them to. So again, it's why we talk so much about a structural problem that is going to take years to not only solve, but also to redirect and reconfigure some of these key pieces. So then when we look at some of the interesting components, China's holdings of U.S. Treasury securities, now people are looking at this and saying, well, they're getting away from the dollar. It's like, well, no, it's exports have slowed, imports have slowed, and they need dollars to help solidify and protect against inflation. They've also actively been selling dollars and buying CNY. So they're trying to manage, but you can only sell that if you have it. So what do? You pull forward some of those securities. Saudi treasuries holdings dipped to the lowest since 2016. But remember, 2016 was when they were liquidating their assets because they were in a price war. And they needed to sell down their treasuries to pull forward dollars. So everyone looks at this as a means of, well, this is the de-dollarization. It's like, it's not. They're using this to manage flows. And why do they have to do that? Well, investor focus is now shifting to the Zhangrong, which we just talked about, which told clients in a meeting earlier this week that the firm missed payments on a batch of products on August 8th, adding to delays on at least 10 others since late July. At least 30 products are now overdue. And they also halted redemptions on some short-term instruments. So again, that's why the focus is honing in here, and this is where you're getting a very big problem in terms of where's the value, and how do they stave off this inflationary problem, or I shouldn't say inflationary problem because they don't have an inflation problem. It's how do they stabilize their not only just economy but also their collateral. Like, where are they getting the collateral from? And that's where you're starting to see some of this liquidation. So then when we look at mortgage lending is going through the biggest decline in its history. And again, rates lower won't do that, because if you look at, and this is what we were referring to earlier, total value in residential property is over 60% in China. It's 65% in China. So 65% of a person's wealth is derived from residential property. It's not that way in the US, Japan, UK. And the only place that is equivalent on the residential property side is South Korea. It's very difficult to try to drum up more spending if people are still taking this pain and realizing these huge losses that they've taken from these trust products. Now, it seems like terrible luck and amazing coincidence that so many things are going wrong in the Chinese economy. But this is what we've been saying. It's like there's so many cracks and they're all interlinked, and there's no way to just ring fence it. And that's why we talk so much about structural problems versus cyclical. This is more than just a cyclical issue. But for those that have been in the market a long time and understand cycles, the cyclical down move creates the structural, shines an ugly bright light on the structural problems. And that's where we sit right now. So businesses, banks, local governments, and households who are implicitly or explicitly take too much one direction risk systematically outperform those that don't, until eventually the operations and balance sheets of those in the economy, then obviously the leverage benefits to the upside, but hurts even more to the downside. So variable final reverses, the damage can often be much greater than anyone expects, mainly because no one understood the extent of the implicit or explicit exposure, as we've talked about on a directional basis. Decades of surging property prices, expanding liquidity, and contracting credit spreads in China created an economy in which balance sheets have highly correlated mismatches and distortions. And again, that's what we're seeing unwind here. Travel, hospitality, restaurant sales remain strong while other things weaken. So what we were saying is people were still going to do stuff, but they're not do events, things, but they're not going to buy stuff. And that's what we continue to see. So service consumption ran strong, but retail sales lost steam with luxuries, apparel, car sales, furnitures, appliances all weak, while some of the other things with restaurant sales and hospitality stronger. The volume across retail subsectors gives you an idea of some of these slowdowns and how some of them have actually turned negative, which is what we've been saying in terms of these underlying problems with what we've seen and how we continue to see that playing out over the next few months, because we don't see the consumer getting better. We actually see it getting worse. China credit impulses, as we were talking about, is negative, and it will go more negative, and we have a chart in the next slide showing that, which is why they're trying to, again, adjust that a bit higher. And then when you look at Chinese property giant Country Garden, consistently underperformed the Hang Seng Mainland Properties Index, and it's going to continue to underperform because of the debt issues and the underlying risk. And that is going to be another big problem. And here's where you can see that you had that drop in credit impulses, but you now have a little bit of a bounce. That's what they're trying to do. They put a ton of new liquidity in because they're trying to hug against zero. And that's what we've been saying is keep it at zero or below, because they have to provide some support, but within reason, because even though there needs to be stimulus, they recognize the fact that they're in the law of diminishing return spiral, and they can't do too much because it won't add any value. It'll actually detract value, where every one new dollar creates a negative util, and that's where they sit right now. So then when you look at the long forward dollar bond slump, it continues to move into distress levels. So you're not going to get outside benefit or outside investors because they're looking at this, and it's going to be very difficult to know what is safe and what isn't. So then when you look at China consumer prices versus real interest rates have gone up, but again, consumer prices can remain under pressure, which is why they've come and they've reduced the lending facility rate, but there's no demand, so you're not going to get any of that, the absorption or people borrowing at this point in time. Then you look at the official fix, they continue to step in and try to protect the currency, and then that's when you start looking at the additional activities that we've been highlighting, because they're trying to keep things stable and trying to keep the currency from weakening too much. This just puts into perspective the volumes in which we're going. The trend is just moving in the wrong direction, and we think it continues to move. Not that it goes into contraction, but the trend and the growth isn't there. Retail sales value just shows you kind of where it sits in regards to other things. On a cumulative basis, you see how it's well below where we were in 19 and 18, 21, as well as 22. So again, you're trending in the wrong direction as we look through the rest of the year, and the monthly new loans aren't there. So now mind you, this came out first, so then the new loans data came out, then they cut rates because they're gonna try to prop this up, force some of this liquidity down, again, because the credit impulses have gone too negative. So they're still net negative, there's still net coming out, but they still need some of that coming through because they can't shock the system given the underlying issues they have in terms of rates, in terms of debt and leverage. They need the ability for some of these guys to roll, but as we said, it's going to be rolling into a market that doesn't want it, demanding higher pricing. So now when we look at non-resident net investment in Japan, shifting gears into the yen, you can see that essentially people are not investing in Japanese bonds, because why would you? The risk is too great. So realistically, you'd short bonds because the BOJ is sitting there buying them up. So you're going to short there, which means you're going to be short yen, and you're going to buy, let's say, U.S. treasuries and U.S. dollar. So you're going to create a carry trade because you have to pay to short the yen, you have to pay to short the Japanese bonds, but you're making a ton of money elsewhere. So that's where you're getting more and more of this carry trade. Now, when we look at India, just to kind of bounce back and forth for a moment, so India industrial production was expected at 5%, came in at 3.7%. As we were saying, we see some of this slowdown. India manufacturing production came in at 3.1%. Again, it'll slow, but it's not going to be this huge all stop. Now, when you look at perishable food CPI and non-perishable food CPI, you had a huge surge up. India wholesale price index expected to be at 2.5%, came in at negative 1.36%. So still down, but again, that gap is closing. And then it was officially closed when we look at what happened in terms of underlying CPI. Survey was for 6.5%, came at 7.4%. A lot of that was driven by food, which took it above the RBI's expectations, where the range is between 4% and 6%, surged well above. Cereals and products came in at 10.6%. So core is trending in the right way, but that's going to start to reverse as well when you look at food and the implications that food has for the inflation within India. And then India exports continue to slow. But again, not like we're seeing from China or South Korea or Taiwan or Japan, but they're still slowing. And that's, again, just the general trend that we're seeing at a global economic level. Now, when we look at Japan, the Japanese economy was expected to grow at 2.9%, grew at 6%. A lot of that was driven based on some of the deflator and the nominal side. Because when you look at private consumption, it was actually negative, came in at negative 0.5%. When you look at business spending, it was actually flat. Inventory contribution was negative 0.2%. So what benefited? It was net exports. Net exports was a huge driver to growth, but as we've been highlighting all through Q3, that is gone. All of that benefit has diminished, and that's where we see more pressure, which you can see here with imports expected to be down 15.2%, only down 13.5%, but still down way more than the previous month. Exports also down, showing that, again, that continuous decline as foreign buying, Japanese buying of bonds continues to disappear, which is why the Japanese are struggling to close some of these deals and to try to get people to actually come in and buy their debt, with machine orders also missing estimates, expected to be up 3.5%, came up 2.7%. So the general slowdown continues. Now, when we start looking at how the currencies are working, this is looking at the Chinese renminbi, and we just wanted to compare the two right now. So here you can see it's at 7.29. Right now we're at 7.28. And you can see going back to 2009 when they still had the peg and then they let it free float, you're getting this idea of just the pressure that the PBOC is under, trying to keep things from weakening too much, but they're fighting against the yen. And this shows you how they're fighting in the yuan. So far this week, the central bank has sought to stem yuan drops with stronger than expected daily fixings and announced an additional bill sale in Hong Kong. The latter move helped tighten yuan liquidity in the offshore market, sending a measure of the currency's borrowing cost in Hong Kong to the highest in more than a year. On Thursday, the PBOC added 163 billion yuan of cash on a net basis through reverse purchase contracts, following the near 300 billion yuan put in on Wednesday. And this week, authorities asked some investment funds to avoid being net sellers. So they're trying to slow down the bleed, but it's very difficult. When you look at how Japan is, this is just, again, looking at the real GDP, how GDP is set up. But then the underlying, so you have business spending slowing, you have private consumption slowing, and look at capacity utilization index never got to the level that it was at in terms of where it was against pre-COVID. So then when you take that and put this all together, you look at the Japanese 20-year yield jumps after a very weak auction. So the 20-year bond auction met weak demand, pushing a measure of investor appetite to the lowest since 1987 and setting off a slide in long-term government debt. So the yen is sitting here at 145.70. One of the things is they're trying, the BOJ is trying to hold it at 145. They're trying to hold the 10-year. Our view is that they're going to have to yield and they're going to have to raise rates, because if they don't, they're going to get hyperinflation. And we expect to see the yen go to 150. And if it breaks 150, it's off to the races and there's going to be a huge problem. And that's why As we said in October of 22, we thought Japan was the most likely to have a failed bond auction. And that would just send a spiral through all of these countries. The U.S. has already been downgraded. Municipalities have been downgraded. U.S. banks have been downgraded. And if you think that that isn't going to have an outsized impact on the structural problems within China, well, that's just the way this is going to go. So I don't know what to tell you. But if you have any questions, please let us know. I know we covered a lot in this segment, but I think it's an important one. It kind of brings everything together, and we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.